Let last week's soybean market performance be an example of the volatility farmers currently faced when selling their products. The soybean contract for March lost 42.5 cents. But is marketing in today's time more difficult than it was during the 1960s? A recent Cornhusker Economics article from Fabio Mattos analyzed price movements in corn and bean markets over the last 50 years to determine first if there was in fact more volatility, and second, if those swings were more likely to be positive or negative. We recently talked with Fabio and started by asking why he decided to analyze these trends.
My main motivation here was the whole discussion about risk. We always talk about risk in very broad dimension. And it always bothered me that people talk about risk, implying the idea that we have something to lose, that we are afraid to lose something. But then they always look at volatility when they discuss risk. And by definition, when I always think about volatility, I think about price going up and down all the time. But if you have this idea of risk in terms of losing something, what really matters is only one side of this, price going up and down. If you're selling corn or soybeans, if you're a producer, you should be concerned about price going down, not price going up.
Sure, because there's upside on the front end of that.
Right, exactly.
Yeah, so you're looking at 4 time periods, August 1959 through July 1972, and these are all August to July's, 72 through 88, 88 through 2005, and then July 2005 through May 2013. And you're looking at what? What are you trying to measure from both corn and soybean market standpoints?
Okay, so the first thing I measured was the volatility itself. So I just calculated all the deviations from the average price change for all those 4 periods. So I calculated deviations above the average and below the average, and then looked at the volatility itself. Okay, and for both corn and soybeans, we saw that overall the volatility has been increasing over time. Yeah, that's fine. But when you say the volatility is increasing over time, you are basically saying that you have more deviations below the average and also more deviations above the average. Mm-hmm. Okay. So you have both this downside risk or this downside problem, and also the upside potential that you just mentioned.
Yeah.
And then the second step of this study was,
is the downside risk greater than the upside risk?
Yeah, should we think that the downside risk is the same as the upside potential, or maybe we have more downside than upside or vice versa?
So in both you found that there was more volatility though, both above and below, more volatility overall.
Yes, exactly.
What about the upside versus downside? Is there more downside versus upside?
Yeah, so when I split the deviations from between upside and downside, what I notice is that most of the times when you have large price changes, you tend to have more downside than upside. Okay. But if you just focus on those small price changes, then you have more upside than downside. So essentially what I'm saying is when you look at small price changes, you have more upside potential than actually the downside risk. But when you look at the larger price changes, then you actually start having more downside risk than upside. And I like to make this distinction because I think we should be much more concerned about those large price changes than the small ones. Because one quick example I have here is, let's say you have a business and you lose money for 20 days in a month, but you just lose $10 each day. But then there's one day in this month, only one day, that you lose $1,000. So it's much worse to lose $1,000 in one day than to have very small losses over several days. That's why I like to look at those large price changes.
Knowing this now, knowing that it is more volatile in both markets than it's ever been, and that there's downside risk as well, is there any way that you can use this in the future to market?
Yeah, so one point we can take from this is that, as I said, there has been more volatility, so the price changes have become larger than in the past. And in addition to this, when you look at those large price changes, they have become more frequent than they used to be in the past. So there has been more downside risk than upside potential, and the downside risk has become larger than in the past.
So can you replicate that forward?
Yeah, so if you think forward, and that's something I'm going to talk more about in the next month in the Cornhusker Economics. But when you look forward, based on this study in the last 50 years or so here, What we also notice is that if you look at results from one time period and try to replicate this for the next time period, usually it doesn't work because the next time period tends to be worse or tended to be worse based on this history here. So if you look at what we have right now and try to replicate for the next 10 years or so, based on what we see here, maybe it can be even worse than we saw now. So it's hard to focus on one time period and try to replicate to the next. But the message from this is there's a chance that things are going to become even worse for the next 10 years or so. So there can be more downside risk and more volatility.
Fabio's articles on corn and soybean market volatility can be found in 2 separate Cornhusker economics reports. We'll link to both of those on the Market Journal website.